Hello and welcome to another ACY Securities podcast or videocast. Today I am lucky enough to have Michael D with me from Pythagoras Investing, and we're going to be talking about volatility. So to get straight into it, Michael, what is it that Pythagoras Investing does and what is your role in the company?
Sure. Pythagoras Investing makes recommendations in the stock market, and we do that by using maths, and we use the maths to construct volatility. And within volatility, we know that share prices react to changes in volatility, not the other way around.
Okay.
So therefore, we can predict share price behaviour and we use it. We just trade ahead of it, either buying or selling.
I would love to hear a little bit more about that, but for now we're going to find out a little bit more about you. So how did you sort of start investing?
Yeah, okay. So
we're going back here, aren't
we? Yeah, we are going back. My first degree was in accounting, and for anyone who's done an accounting degree, you know that that's not really all that interesting. But one of the things that I did was become quite interested in the listed market.
Yep. And
I learnt from a friend who had been investing for several years, and he was reasonably successful, and he was just a genuine thinker about things. And so at the time, so we're talking about the early 90s, we had the listing of APN News, which doesn't exist anymore, Fairfax, which doesn't exist anymore, Woolworths, and quite a lot of other companies that came out of John Spalvin's Adelaide Steamship. And so I happened to strike a relationship on purpose with a good broker who was able to get me a flow of IPOs or initial public offerings. And I was only able to get $2,000 or $3,000 or $5,000 worth, but as a final year student at university and then a first year accountant, making a few $100s here and there was just a great thing for me.
That's the pub money on the weekend,
absolutely.
Right?
But it set my interests alight. I suddenly became quite disinterested with accounting.
Yep.
And I lasted 1 year in a chartered accounting firm, and I pretty much resigned on day 365. And I went back to study, and I did what was FinCEA's graduate diploma, and I did a marketing degree, and I did my CPA for some reason, I'm not sure why, all in a year. And then I started working full-time as an investment analyst and portfolio manager in South Australia.
Okay. And when it comes to your very first investment that you ever made on a listed front, what was that? Do you remember what it was from back then?
Look, I was trying to remember this. I think it was probably APN News,
okay,
or Australian Provincial News, which were just regional papers.
And I suppose that very first one you've done would have had to have gone somewhat successfully, because otherwise you probably wouldn't have continued to invest today.
Absolutely. Now, IPOs at that time were a bit different from what they are now.
Yeah.
It used to be that you'd put your money aside for 2 or 3 months. It was a fixed price offering, and the time in the market was such that it was important that they were successful for the long-term benefit of the broker and also for the company. So
what do you find different between IPOs back then and now when they happen?
Yeah. So if we wind the clock forward 25 or more years, the time to market is much, much finer. So you can put your money down and in a number of weeks you're going to get a result on the market. Now that's a great innovation. But what it means is that there's a lot of price soundings that happen at the institutional level, and there's typically a bit of preference that's given to institutions over mums and dads. So these days, the pricing is much finer, the profitability of an IPO is much more subject to the whims of the market, and the investment banker's role is different. It's more about creating profitability for the firm, as well as creating a very fine outcome for the company.
Okay. So you find that there's obviously a pretty big difference. Do you still invest in IPOs today?
Less so. I find it's less acceptable to me to actually put my money down for any extended period of time. So even a matter of weeks isn't all that exciting to me.
Right. And what do you generally invest in today? Have you got some preferences that you would deal with and outliers that might be a little bit different to others?
So it's quite broad. It's all in Australian equities.
Yep.
And I have a heritage in small companies, so I enjoy small companies and the offerings that come out of that part of the market. But what I've learnt over the years is you don't have to take the sort of risks that small companies pose. You can still make excellent returns in big companies. So I invest in big miners, I invest sometimes in biotechs, I invest in rather dull and boring things as well. It's very much subject to the environment we're in and the opportunities that present.
Okay.
And Pythagoras helps me with that.
And how do you sort of assess the risk when it comes to some of these companies? Naturally, if we go for the idea of a biotech sort of firm, they are sort of the thing that's going quite big right now. But there is some level of weighted risk that we're seeing at the moment when it comes to the idea of, in the middle of a pandemic, we have a lot of sort of tech companies trying to produce something that might help with the tracking and monitoring of a virus, but also we're seeing on the medical side of things and trying to track vaccines. Have you found anything that has really piqued your interest at the moment in that sort of realm?
Yes, you've got a resurgence of interest in biotech, which goes in cycles. So biotech is a pro-cyclical style of stock.
Yeah.
When the market's running hot, they tend to be the ones that run hotter.
Okay.
Now, we're in an environment that's not really been hot. We've been in an environment which has been unique to coronavirus.
Yes.
So we've got an environment that isn't conducive to biotechs naturally, but people are interested in them because they think they might catch the next 10-bagger, 50-bagger, 100-bagger. Now, for those who don't know, a 10-bagger is just 10 times your money.
Yeah.
Now, the reality is that whenever I've sought to make a 10-bagger, I almost invariably haven't. And so one of the things that, again, the mathematics of volatility allows us to do is make investments in these stocks, be in them at the time where the opportunity is right for making money, and be out when it's not. So just as an example, not a recommendation, Mesoblast got down to $1 at the height of the pandemic. It's now in the mid $3 range. And so that's not a natural thing that would happen. It's quite artificial based on this race for the solution for coronavirus.
In terms of what you're trading with these days, can you tell us a bit about how your day-to-day sort of trading might go? What sort of equipment are you using? What sort of software are you looking for and or using as well? Is there any specifics that challenge how you might go about it?
Sure. If I keep it to the answer to just trading as opposed to Pythagoras, because they're quite separate.
I'm happy to hear both.
Okay.
I'm quite interested in hearing both,
okay.
In fact.
So if I start with just my trading, there's not a lot that I need. Once upon a time, you really needed an iris terminal, you really needed a lot of things that weren't able to be acquired on the internet. Right now, I can achieve just about anything for free on the internet. And so for me, that's very straightforward. I use an online broker and I'm very aware of having a HIN and making sure that I've got control over where those stocks are invested. But other than that, I'm really looking for someone who doesn't provide me advice, just gives me the execution that I require. Okay. So it's quite simple.
Yep.
As opposed to Pythagoras, that's different. We have we have 6 servers that run pretty heavy mathematical code, and I've now employed my 7th programmer. So we're very, very heavy into the technological side of things. The reality is, to the client, that doesn't matter. They get a simple buy or a simple sell with a price range or a timing. So
they're looking for that sort of simple side, spoon-fed almost solution.
Absolutely.
Versus at your end, it's incredibly tech heavy.
That's right.
So do you find a lot of challenges with having to run that sort of software when it comes to being able to sort of make some of the calls or the advice that you do give? Is it still come down to, there's still obviously got to be a human element that's involved in it? Do you find that sometimes that data conflicts?
There's no day-to-day human involvement.
Okay.
The thing that we find is that the internet framework or the texting framework or the emailing frameworks sometimes just don't work. Or our servers can decide that today or this morning's not a great time to be working. So there are those normal challenges. And just out of interest, this pandemic has actually caused us the most number of problems because things are not getting fixed quickly.
Yeah.
So it's been quite challenging in that regard.
When it comes to sort of the rules that you apply to your own trading, do you have any principles or I suppose rules that you sort of live by, that you sort of use in your day-to-day trading, or are there perhaps certain ones that might impact how you would consider looking for a potential investment or an opportunity?
That's a big question. If I think about the things that I'm attracted to, I'm very attracted to companies at a fundamental level initially.
Yeah.
And if I can't understand it, I won't touch it.
Right.
So that's a rule that I abide by. Secondarily, if it doesn't make money, I'm less inclined to be interested unless I see a massive opportunity. If I'm looking at the day-to-day, I'm looking at the volumes that are trading in the stock, I'm looking at the size of the stock, and I'm looking at the behaviour of the way the trading actually occurs, on the basis that I've been caught in the past with stocks that really don't trade very often.
Yeah.
And as much as you might wish it to trade when you're trying to exit, or wish it to trade when you want to enter, it doesn't necessarily happen that way. So I'm very sensitive to those things. In terms of the way I work, I'm very much intuitive with the way I look at the markets. When I've got an opportunity to buy, I will monitor for 5 or 10 minutes, 2 or 3 times a day, and I get a feel or a sense for the market, and I'm sure you would as well.
Absolutely.
You can see almost through what's going on, and so for me I find that quite simple and straightforward. For other people that don't believe they have it, you don't need it. It's just that it's something that gives me a little edge.
I think the best way I can describe that same sort of feeling is that I sort of formulate a picture in my head of what an economy is or a business is and who the competitors might be, almost like a mind map, I suppose, of that situation. And unless I have that image where I can literally shut my eyes and go, that's what it looks like, then it becomes the case of I don't know enough about what it might be that I'm considering looking at. So a stick to what you know sort of principle seems to be a common theme that I'm finding with a large number of investors. And keeping in mind with this, sort of this picture in my own head, what's the picture on your head about the current market that we're seeing right now?
It's interesting. Look, markets always overreact. That's certainly true of equity markets. We knew that in the middle of March, I wrote a note, it's probably a little bit inappropriate, but the title of the note was "The Lunatics Are Out of the Asylum," because that's literally the way I felt in the middle of March. There was no rationality. We had a set of circumstances that weren't great. We didn't know enough, but we certainly didn't deserve to get down to 4,450 on the ASX 200. And 1 week later, I wrote another note, which was "Lunatics be gone," because my logic at that time was we saw enough of what was going on in China to understand that this doesn't last forever. It'll play itself out. And if you can hold the line and hold your hope and start to build some resilience in your own decision making that this will finish, and then map yourself into the future and think, and this comes to your point of view, can you see in your own mind that coronavirus would finish? And if it would, when? And if when, what would it look like? And what would it start to look like more broadly? And therefore, what would it look like for the economics of each country, of each environment, of each submarket? So for me, I started to develop a lot of confidence in it, and that's why "Lunatics Be Gone" became the title of the note. Now that was the 26th of March. Now, that happened to be the bottom of the market. I'm not saying that for any other reason other than my logic was we could see the other side.
Yeah.
And I think that's so important because the seeing of the other side is the thing that makes the difference between, oh my God, where's the bottom? And oh my goodness, I can now see that we're going to have a lead out of this. So for me, I initially started to look at the way the Chinese market was behaving a couple of weeks after that, and I noticed that they were no more than 10% down at their lowest point. And I looked at America and Australia and the way we were all behaving, and the way we typically behave is that overreact.
Yep.
And then I made a comparison to China, and I came up with a target of 6,450, I think about the middle of April, which probably sounded crazy, and maybe it was. But I've recently upgraded that to 6,800 on the ASX 200 on the weekend. And that is because, and that's for February of 2021. So what I'm saying is that we're going to be 5% down by the end of 12 months of what has been an extraordinary period. Now, I'm not saying it's going to be up every day. It just can't be. In fact, I'd be very uncomfortable if it was up every day. I'm already starting to feel uncomfortable with the number of positive days that we're experiencing at the moment. But just as when every day is negative, you know that we're one step closer to a turn, every day that it's positive, we're one step closer to a turn. Now that just means that we've got more volatility and more uncertainty, and we've got lots of events to look at for that. Not only have we got the US election, we've got the potential reigniting of the trade wars with China and America, China and Australia. We've got skirmishes on the Himalayan borders between China and India. I firmly believe we're going to end in trade war between China and India as well. There's so many geopolitical events that are sitting out there.
When it comes to trading in general and how your thoughts are about, general investing and whatever it was, if you had a time machine and you could go way back to when you first started, and you could go to yourself and grab yourself by the scruff of the neck and shake yourself and say, hey, you should do this, not this, what would that piece of advice be?
Again, a probing question. I think it actually comes back to behavioural biases. And by that I mean one of the things that you have to be is a bit counter to most things that are going on. And therefore, if we took the oil market, for instance, as an example, when oil was down at about $11, $12, I filled my boots with oil stocks when people were afraid of oil. And that was only something that I could do because of the experience I had to this point.
Yeah.
That I could look at it and say to myself, okay, this is the situation we're in. And really think it through and think about the planes and trains and automobiles that we're not using at the moment that we will use in the future, and therefore the oversupply of oil relative to what will be normal supply of oil relative to a demand profile. So therefore, when I say being counter, that's what I mean, to be able to have a view, to stake a flag in the ground and say, well, this is my view, and these are my reasons, and this is why I'm now very comfortable to choose that stock and trade them as you go. So that would be probably the first one. And I think another one, again, behaviourally biased, is instead of being affected by the crowd, and if I took you to an example, the tech wreck, or pre the tech wreck was the tech bubble. But through that period, I read literally hundreds of prospectuses and hundreds of business models, and went through literally hundreds of businesses that were in that market.
Yeah.
And this is probably where my avoidance or my lack of interest in stocks that don't make money comes from, because the number of strategies and business models that I come to understand through that period was just incredible. But as a fund manager, to stand against that part of the market that was absolutely going gangbusters took real guts and real tolerance, and it probably lasted 2 years. And those things grind you down. But I would also tell myself, stick to what you know, stick to what you believe, choose the correct companies, and make sure you actually stay true to yourself and true to your own investing nature, rather than get caught up in the herd mentality, which says, wow, it's going up, it's going up forever.
Which I suppose is what we're seeing right now when it comes to, the pushing up of price across equities across the board. When we're seeing nearly 30 times in some instances or some days of daily trading volume. So there is a little bit of herd mentality going on, and a little bit of self-fulfilling prophecies. Now, I have a question I like to sort of ask everyone who comes on the show, and it's really got to do with how you would invest $10,000, $100,000 and $1 million if that's all you had. And if there are any differences between how you would invest that. So I suppose the easiest one to start with is obviously $10,000. What would you do with $10,000? Would it be a trip to Vegas, or would there be something a little bit more on the profile there for it to be an investment?
Sure. It probably sounds unusual, but for a guy who makes recommendations and trades for a living, I think I've been to a casino once and I've probably put down a sum total of $50, and that was my experience for life. And I really don't have an interest. If I had $10,000, it's interesting because my youngest daughter is now 18, and she came to me in the last half a year and said, I would like to understand more of the stock market. And so we agreed we'd put in some money together and we would do exactly this $10,000 problem. Now, given her interests, we really did go to a biotech. And we made a little bit of money, but again, remember, we were going to try and make double our money.
Yep.
And after a while, we made a little bit of money, and I said to her, look, this is not working for me. And she said, well, it's not working for me either. So what we actually did was we cut it into 4. And we waited for a little while, and then the pandemic was on us. And so when that started, we just did some simple things. And like when I said to you, you don't have to take small company risk. You can still make good money. So I'll tell you what we bought. We bought some Rio, and we bought some Woodside, and Beach Petroleum, and Santos. And we took one giant bet on the oil market. Now, it still wasn't diversified. It was very, very commodity driven, and it was very oil driven. So we still took extra risk, but the reality is 2 months later we've made 50% return.
Yeah.
And so, and there's one other we had in there, which was Afterpay, which we bought it just after the turn at about $13.50 and sold it at $40. So we did pretty well there.
I've been enjoying Afterpay and Zipco myself for a while now, but I kind of look at it and think, I've got to wait until the next thing. But now Zipco are apparently, they're going to be looking to do a push into the US now as well. So that might see some good things for them to come yet.
Big markets with no money.
Absolutely. That's the concern that I have for a lot of them at the moment. Now, the next one is obviously 100K. So in the 10K question, you were looking at sort of a little bit probably higher risk to try and get as much return as possible. We're talking about doubling our money in a very short period of time. With the 100K, it's a much larger sum. So would that risk profile change, or would you still be looking at doing the same thing, or would it be much greater diversification? What do you think would change?
Sure. The reason why it was so focused was such a little amount of money.
Yeah.
So, and that's a logical thing to do.
Yeah.
In 100 grand, the example, what I would do is then broaden the breadth.
Yeah.
And so I would actually add other sectors. I still wouldn't make investments in stocks that I didn't believe in.
Yep.
For instance, I'm not a believer in banks at the moment. I think moral suasions actually from the government is going to lead to a bad debt position, which I don't want to have to fund.
Yeah.
So I wouldn't go to the banks, but I would broaden the investment horizon, some renovators, some of the construction style of companies rather than the house builders, and actually build the portfolio out from a diversification point of view rather than keep that concentration but just magnify the bets.
Okay.
And I know you're going to ask me the next question, which is what if it was $1 million? And that would just expand your diversification from there. I've run portfolios at $1.5 billion and sometimes $10 billion. Once you magnify the numbers to a certain scale, you're not looking at the numbers, you're looking at the percentages.
Yeah.
So one of the rules of thumb for me in my own portfolio that I run my super fund is anything greater than 25% as a single bet is highly unusual and is only for a very specific set of reasons and for a very specific time. So as an example, Rio I took quite a large bet in when it was down in that low 80 and high 70 in the same sort of period through the pandemic, I really went hard on that. But I try to keep stocks at about a 10% position, and I'll have the occasional bet where it'll be 1 or 2%. And to me, that's if it doubles, I'm happy. If it halves, it's not going to hurt me too much.
Yeah, okay. So it is a case of, you diversify yourself very differently across the board, and you increase the amount of sectors that you're going to be looking at, and you might change within those. So would you do the same in the 10,000? You basically stuck with one sector, but then split it across 4 or 5 entities. Same sort of thing applies for each thing. If it was going to be, if it was in the $1 million case, it'd be 100 grand split across 4 or 5 in one sector, and then keep going that way so that you're in multiples. Or would you then look at perhaps looking at putting some into property and then some into something else, or into ETFs or whatever it may be?
So if I just answer your direct question, the 100,000, I would have say 10 or 12 stocks.
Yep.
And if it was $1 million, I would probably only have 15 to 18.
Yeah. Okay.
Because I think you start to get firstly, there aren't that many viable companies.
No.
And because I'm trading them, I'm not always owning the same company through that period of time.
Yeah.
So I will change depending on the outlook of the individual.
And of course, there's also that sort of rule of thumb that anything over between 20 and 30 stocks, you don't really balance out your beta risk any more than if you had 100 stocks. That risk still applies the same. Once you get that low, you've diversified so much already that it's not going to reduce that risk anymore.
And you've got an amount of work that comes with owning a stock,
yeah,
owning 10 stocks and owning 20 stocks. And I've always found, again, sort of rule of thumb for me is, once you get north of 20, you're actually creating a lot of work for you.
Yeah, absolutely. And if you're not keeping up to date with it, you're not in the know, and you can't have that picture in your head. So when a strategy does change for you in terms of these sort of things, would there be, when it comes to sort of the 10K, the 100K, the $1 million question, what would change your strategy ultimately into something completely different? And do you think it would be different because of the current environment now? Like what you're doing today with the pandemic sort of situation and what you're investing in now, is that entirely different to what it was 12 months ago?
Okay. Yes, it is. At the time of the real striking of the pandemic, and I'm talking about through March, I took a lot of time to deeply think about the stocks that I wanted to be in and the sectors that I wanted to be in and didn't want to be in. I've never been afraid of holding cash. And to me, cash is an equally valid investment by comparing it to anything else. If it's in cash and it's in the bank, I know where it is and I know it's safe and I know it's just there.
Unless you're in Greece, in which case get a mattress.
It's there waiting for the opportunity to arise. And I've genuinely run portfolios for people where I've had 90% cash.
Yeah.
And I've also had clients ring me when I was running those portfolios on a Sunday morning saying, how much cash have we got? Because can you believe this market? So people who understand this style of investing are very, very happy to be working their way into the market when things are tough.
Yeah.
Now, therefore, all of that deep thinking led me to a number of different areas that I definitely didn't want to be in, and it led me into areas that I hadn't really considered all that carefully. So I'll give you one. Car sales was one that I looked at and I thought, effective monopoly has been a very expensive stock. It's traded very well with Pythagoras. It's done incredibly well. And for us, I've looked at it and thought, got from $19 to $12. And so during the pandemic, it showed us an opportunity. And I thought to myself, oh, okay, righto, new cars aren't going to be bought because people haven't got the jobs, but second-hand cars will. And when you look at the way that business has behaved and the movement of eyeballs has behaved, the second-hand car market is actually very, very resilient. Now, if I'd have looked at it at that 12 months ago, I wouldn't have looked at it with that knowledge and understanding. And I was a little bit attracted, but I always thought it was just that little bit too expensive. When it got to $12, it was actually showing me more of what it was. And it was giving me the opportunity, and having done that little bit of work, it's actually turned into a 35% return in not a lot of time. So yes, I did look at things differently, and I did things differently, and I looked for all of those qualities that I thought that would be required to see out the pandemic. And then once I'd chosen those stocks, I used Pythagoras to trade them.
Okay, so there is obviously difference between what's then and what's now, but in terms of something a little bit off topic here, what's the most recent book or TV show that you've really enjoyed? Because not everyone can always live and breathe the markets non-stop. So people need to know that we do watch TV, other than CNBC or anything along those lines.
Absolutely, it's a bit addictive, this industry, and it can actually consume you far more than what most people would realise.
But it's very, very easy to run into burnout.
Yeah, but if you love it, it's less of a problem.
Yeah, absolutely.
But when you're tired, you're tired.
Yes.
And so for me, I've been watching Ozark, or Ozark, however you say it.
So you're still watching a finance-related show. I don't know if that counts, but we'll let it slide.
I did enjoy it, and I am still enjoying it. But I suppose we're all looking for entertainment that just gives us that little bit of time off.
When it comes to the entertainment side of stocks, do you like things like Netflix and Stan and any of those sort of publicly listed ones, or I suppose Amazon can be looked at from Amazon Prime's perspective?
Sure. Look, I invest only in the Aussie market.
Yeah.
I acknowledge that there are opportunities, therefore, that we miss out on.
Yeah.
But if I take the concept to its root, and that is, do I like media and entertainment? The answer is yes.
Okay.
And the answer is yes, because they're economically sensitive, and therefore they have an inherent volatility. And when they've got volatility, one thing I know is you can make money out of them rather than being deadpan and boring. So,
well, we'll come back to the volatility in just a few moments. Have you got any sort of trading books that you would recommend to someone that might be looking to get into trading for the first time, or is there a book that's your favourite that might have been about investing and performance ratios or whatever it may be? It could have even been an accounting book that gave you a lot of interest and helped you along your way, that's made a difference towards where you are today.
Sure. The short answer is no, not really. What I did, which was probably the most beneficial thing, was, even though I didn't enjoy my accounting study, it actually helped me enormously, because when I read financial accounts, it sounds lame, but the numbers actually sing to me. I can actually, they mean something to me, where so many people read financial accounts and they don't mean anything.
Yeah.
So that's a wonderful thing, and that's a wonderful discipline, and I wouldn't ever change it, even though I never really got to use it in a professional sense. I think the biggest, most beneficial thing I did was I got right into strategy and company strategy, how it worked, why it worked, and what you needed to have a strong, sustainable competitive advantage. And even things as simple as Michael Porter's 5 Forces, which is probably a bit off topic.
Well, not really. I actually know the book.
Yeah.
So
now it's meant to have been debunked, but to me that doesn't matter, because it leads you so many different places. And so I did a 4-day intensive at one of the universities, and thoroughly enjoyed it. And I found that just thinking about those things made investing that much simpler, that it wasn't fun.
Well, funny you mention it, because I actually do, I suppose, I've used 5 Forces before from my own university education at different times, and there's obviously been the talk about there's also 7 forces, and then sometimes it's 3 or 4 or whatever it may be, the variety of different ones that you can look at. But the principal foundations that I've always used or adopted from the sort of 5 Forces ideology is to really how you think about an economy and how it works, and sometimes how a particular business works as well, and it sort of goes towards building that picture inside my own head. So I've always tried to sort of explain that to some of the other people who always ask me questions, or some of the students I've taught over the years, a variety of different things, but I've always found it interesting. What do you think is your best trade you've ever had?
Okay, I think probably Worley Parsons.
Mm-hmm.
And there's 2 sides to this. I had it at the float, and I bought it continuously from $1.70, I think the float was.
Yep.
And I owned it right the way to $50, and the GFC struck. And it was a most wonderful position. But your next question, I'm sure, would be, what's your worst?
It's in the same trade?
It's the same trade.
I had the same experience. Mine was Lockheed Martin Corporation, and it was, based off sort of looking at military technology things. And it was the best trade I've ever had because it's probably the single most profitable position I've had in my early days. But it was the worst trade I've had because I got out way too early, thinking like, oh, I'm a bit excited here. This is going back 10 years ago. Yeah. So similar sort of...
Well, it's slightly different in that I had left the stable working environment and started my own business in 2008. And so as the GFC happened, I was pretty happy sitting on a nest egg of a number of different stocks, including Worley. And so from $50, it went to $8. And that hurt a lot.
Yeah.
And I kept it through the whole thing because probably a little bit inept in my thinking as to the recovery. But at the end of the day, it turned into what was the worst trade I'd ever made because I really should have sold it a lot of times on the way down, even on the way up. But,
it's funny how it's almost everyone I ask, when it's the best and the worst, it's almost always, this was the best because I did all the analysis, it was right, and then some sort of understanding or some change or whatever it may be happened, which dictates it to end up also being the worst. It's quite funny how often that happens.
And the thing is, you can easily fall in love with a stock.
Yeah.
And one of the disciplines that I don't believe in anymore is bottom drawer investing. Absolutely. And that was one of the things that for me changed my thinking and changed my outlook, because at the time of the GFC it was very, very common that people would say, I'll buy it for the bottom drawer, and obviously just forget about it, and one day you'd retire and it would be worth a fortune.
Yeah.
That no longer could be the case, and the reason is the GFC really showed us how internationalised business really was. And if you think just for a minute, and I know you would have been there and looking at it at this time, but it astounded me the fact that one insurance company in America could actually bring down the entire network of insurance companies the world over. And if you just think about that for a minute, even if that doesn't mean a lot to you, but just think about that for a minute, there were ships sitting in ports that couldn't get insurance so that they could leave the port to deliver the goods through no fault of the owner of the goods or the shipping company.
Or even the captain of that ship.
So the internationalisation, the geopolitical, the effects that can actually occur as a result of these massive indebted changes were just so colossal and persist that I don't believe that you can bottom drawer invest anymore.
So I suppose in some respect what we're seeing now with the pandemic and that globalisation of economies and how they all integrate with one another, including the supply chain element of things, it's almost like completely different catalyst that has started the problem, but we're running into similar issues now. Where now instead of it being that the boat can't leave harbour, it's that the boat can't actually get into the harbour because no one's going to let them in now. But again, it's run into the same sort of consumer level issue, and the underlying causes of it always seem to be different in every recession we go through, regardless of what it might be. Now, we've sort of gone through a couple of different things about how you invest and what you do. So now I'd like to sort of move our topic choices towards more about what Pythagoras investing does with volatility and what you do for volatility. So for the first thing is, for our listeners and viewers today, what is volatility?
Sure. The colloquial definition of volatility is really related to change, how much change there is, and we use that in our normal everyday language.
Yep.
It's not what I do, and it's not what I mean when I talk about volatility. But it's important to understand because price change is meaningful for some reasons, but not a lot. Now, it seems appropriate that we talk about volatility and VIX. Now, CBOE, you would know, the VIX volatility, it's horribly technical. I don't really want to go into the mechanics of it, but I tried to replicate that in the Australian market. And one of the things that I realised during the time of the GFC was It's a wonderful implement or wonderful tool that tells us what was. It tells us nothing of what is about to happen.
So it's as a reactionary device and doesn't actually help you sort of do the forecasting.
That's right.
Element.
So in the GFC, VIX was 12%. It jumped very quickly to 30, then to 60 and 90. And if memory serves, I think it peaked at 110. Now, at any point, if I could have drawn meaning from the fact that from 110 it was going to go to 90 and then 80, I could have actually done something, because the one thing that I know about volatility is if it's reducing, that means uncertainty is reducing. If uncertainty is reducing, then prices are naturally levitating. So that experience with the VIX and the disappointment with the VIX actually led me more to trying to construct what would be a predictive piece of information rather than a reactive piece of information.
Okay, so what sort of information do you sort of look to get out of volatility via this predictive nature?
So if I just expand a little bit more, we create volatility in our proprietary way on every stock that we look at, and there are hundreds of them. And we measure and track and interpret the changes that occur over time for each of those stocks. Now, a stock might go 50 or 60 days of rising volatility, and that has meaning, and we can use the understanding of that meaning to trade the stock along the way. But if you can think of a most basic definition of volatility and the way we would use it, we could look at this chart. Then what we see here is that with a volatility that changes from falling to increasing, the one thing that we know is volatility increasing means uncertainty rising. Uncertainty rising means that share prices will begin to fall. Now, most people can understand that as a concept. For Pythagoras investing, that is our most basic decision. And from there are about 130,000 lines of code that go into looking at the mathematical preconditions as to what should occur as a result of these style of trades that occur. So what it means, and this is quite important, is that change in volatility precedes a change in price. Now that's the complete opposite to what is understood more broadly.
And especially it's complete opposite to what you would see on the VIX.
Absolutely, because the VIX is not giving you any forward understanding as to what's coming. So in a simple way, what we're doing is taking that change, and we can look at that change there and using that to make our prediction of the share price behaviour. And then what we do is we buy or sell, in this case, ahead of it. So that's quite simply how it works.
And when you sort of get that information to sort of determine, whether you're going to buy or sell ahead, I suppose that's sort of a level of a trading decision. Is there more that goes into it that outside of, the volatility side of things as well? Do you have the sort of fundamental sort of look at these stocks? Do you have more data that you assess or analyse?
Believe it or not, it's all in the price.
Okay.
Literally all in the price. And there's a famous theoretician that believed that, and we've proven it to be true. Now, that's not to say that we don't actually look at any fundamentals when choosing stocks, because people want to be choosing the best stock they possibly can. And so in discussions, people will tell me of their interests and preferences and why they like certain stocks, and in those discussions the names that they want to subscribe to come out of it that way. So there's a fundamental overlay in choosing a stock.
There's a little bit of that spoon-fed sort of side that a lot of people want to hear, but the reality of the situation is, how they actually do it is more important should be more important to them than they realise.
And so once they've chosen their stocks, we supply them with the recommendations. Now that might be in the order of 30 to 40 buys or sells over the course of a year. It's very seldom buy and then sell. It's more often than not buy 3, 4, 5 times and phase themselves or diversify themselves into a stock before the sell comes.
So, Michael, what are some of the key metrics that you would look for in a given scenario? Can you give us a bit of an example about perhaps a trade that you've conducted recently or anything like that?
Sure. This chart is actually an interesting example. So this is A2 milk in March and April of 2020.
Yep.
And so this is just demonstrating how we work. So remember, we're actually taking volatility, the changes in volatility, and we're working with the share price behaviour to buy and sell. So that first orange blob there at 1665 is a sell, and that coincides in actual fact with the OPEC meeting. When I look back in time, of course I didn't really know of this at the time. So the OPEC meeting was actually a thing of real substance, because for the first time since 1960 the Saudi Arabians actually went back on their cartel. And that actually caused quite a lot of difficulties, and the ramifications around the world were quite enormous. And stock markets started their slide, as we know.
And we saw then negative oil prices that came in with it.
Absolutely.
So how does negative oil prices, in hindsight, I suppose we're really looking at that sort of factor. I mean, your volatility index has gotten it right, and you've sort of managed to use it in this way. But how does the oil prices affect milk?
Yeah, I see what you mean. So the reality is every share price around the world failed to perform through this period.
Yeah.
And so the events can be small or they can be big. Now these price events, if it's a managing director resigning or a senior official absconding with money, of course we all know what the answer is, but there's a lot that's hidden in price that's disclosed through the use of these volatility indices. Now this one was telling us that the share price was about to fall. There was nothing particularly specific about A2 milk through this period, but it was the right time to sell, as you can see.
Yeah.
Now from 1665, the system then turned around after the price had fallen $1 and $2 and started to accumulate again. Now these are what I call the little smiles that are going on in the stock market all of the time. I call them that not only because of the shape, because they make me smile, because I know they're a formula for making money for our clients. Now this particular example, the share price got down $1 and the system started to buy again, and then it got down almost to $2 and it bought 4 times within the coming few weeks. The market had dropped 18% and our clients get to pocket a return on those each on average of 9.2%. So the opportunity was there and available for many to take advantage of. So,
yeah.
Now it doesn't stop there. Not long afterwards, at the start of April, you can see there's another set of buys, and again, just by coincidence, there's another 4. Now those buys are done at similar prices. There's no smile there, other than I still smile because it's a formula for making money. But not long afterwards, the price is up another $2. And so therefore, you're predicting, the volatility is predicting forward all of the time the activity in the share price.
And then it's giving you an opportunity to sort of bank some cash and then reinvest as it goes along as well. So it sounds like it's something that's absolutely fantastic for some different types of investors out there that would certainly be interested in it. Now, it's also interesting to sort of see that this has all occurred in a period of time where volatility levels were likely, in some of the highest we've seen in a very long time. Yeah. Especially around, we've had the oil prices going negative, we've had stock markets not handling things very well, and that overreactionary sort of nature has occurred. So what do you think has really has that improved the situation for the way that you look at volatility? The higher the volatility, the better it is on your side? Or is it more of a case of, if you go back, say, 12 months ago where volatility wasn't quite so extreme, was the conditions better or suiting to how you look at volatility better then?
If I just backtrack for a minute, it's the change in volatility that forward forecasts the opportunity. So it doesn't matter whether it's 20%, 40% or 70%, it's what comes next.
So therefore, then the idea of tracking an actual VIX index adds no weight to how you operate at Pythagoras. No.
So from our point of view, it's what comes next. Therefore, you might find that the returns are magnified because the extremes of human behaviour have actually found their way into the stock market.
Yeah.
So you're getting the greater opportunities, the deeper discounts, and giving yourself the better opportunity to make bigger returns. But,
Absolutely.
Yeah, so it's relevant, it's just different.
What sort of advice would you give someone today who might be looking to invest? So let's take your daughter, for example, because you were saying that she was recently getting into investing and was asking you questions. What was some of the advice that you may have given her? What would be the primary thing that you think would be, if you're looking to invest, this is what you should look at, or should at least understand?
In terms of choosing a stock or the actual trading?
No, I think just investing in general.
Yeah.
So if someone was interested in getting into investing, regardless of what market it was,
Yeah.
what would be the core thing that they need to go and research, they need to understand?
Yeah. I think it goes back to that, the question of what advice would you give yourself? But choose a stock that's in a sector that's in an upswing, whether that's because of its strategic competitive advantage, or whether it's in an area that's going to be improving in times to come. But make sure you've chosen a stock that's as solid and well understood by you as you can. And then the logic is, you don't need to own it 100% of the time.
No.
This chart shows you that you don't need to wear the risk. And in fact, if you look at the 1665 sell, the reality is you would have looked at that and gone, oh, that's a fantastic time to have sold.
Absolutely.
But white knuckle time, which is what I call those opportunities.
Hanging on to your seat as tight as possible.
So as a client, I'm sure there were several clients who were sitting there saying, why should I buy now? But look at the result. So from my point of view, I think you don't need to be invested all of the time. You don't need to take big risky swings at stocks that you don't understand, or you're doing it because you're going to try and make 10 times your money. That the reality is, if you make a few 9%, a few 4%, lose 1%, over the course of a year, you can actually amass a return that's actually sufficient to make you very, very happy, but not take the same risk as what everybody else is having.
So it's a little bit case of stick to what you know is sort of the repeating element that I sort of hear amongst all that.
Yep, because those price cycles, if you go now and look at a chart, and I'm sure you would have already done it, but others who are listening, go and look at a chart and just see how often these little substructures are there. They're giving you the opportunity for your retirement, and that's the bit that I love about it.
All right. Well, in terms of the most significant opportunities or challenges that you think the industry is really facing from your perspective, what do you see as being the next sort of 1 to 3 years?
Sure. If I take it from the perspective of the funds management industry, I think fee pressure is now accelerating, and what that means is that people don't have the capital to be able to reinvest in what is fundamental research. And the problem with fundamental research, as we talked about earlier, was that if everyone knows the right answer at the right time and you're all reacting, then returns are hard to come by. And it's no wonder these poor fund managers are actually having so much difficulty outperforming a stock market.
It's kind of that idea of mass education of one thing leads to the mass population doing that same thing.
And then when you're all doing the same thing, no one can get it done, and you all just end up being disappointed. So if you've got fee pressure, you've got less travel expenditure, less ability to fundamentally research. At the same time, the information is not all that valuable to you because everyone knows it at the same time. So you've got actually quite a quandary of over the next few years as to how this industry really develops. Now, out of nowhere it seems, but really out of decades, passive investing has happened. And passive investing is just buying an index or a replication of an index, and that being your main form of investing.
So going into something like S&P or the ASX directly?
Yes, or you could even choose a sub-index, an IT index or a banking index, whatever it is that really takes your fancy. And what that's saying is fund managers can't add value. And therefore, what we'd rather do is pay very small fees, and with those fees, we'll enjoy that as a part of our return, if you will.
Which I suppose to a certain degree, it's why, when it comes to performance structures and how much money, you would expect as a fund manager to be generating for you in return, they're always aiming to beat the most leading index that there is at the current time.
And that's what they're tasked to do by and large. But the problem is that by everything going to passive investing, firstly, passive investing is only as smart as the benchmark, and the benchmark is a momentum-based thing, and it's a success-based thing. And if you look at our index, for instance, the ASX 200, I think CSL is 13% of the index. Resources are 18% roughly. Banks are 25%. Now, again, with my view of banks, why would I want to allocate 25% of my money to a sector that's going to struggle with bad debts? So by trying to be cheap with our solutions, by being disenfranchised with active managers and the fees that they charge, we're kind of throwing the baby out with the bathwater.
Yeah.
And the reality is there are some incredibly talented people who can add value as active managers. And they're the sort of people you want to pay. And you want to pay them well, because if they do well, you're going to do well. But these are the paradigms that are playing out within the industry, and there's no very simple answer. And now we're seeing the future fund becoming what is now an uber long-term investor, ignoring stock markets, ignoring benchmarks, and actually just looking for CPI plus or something similar. So there are a myriad of different problems that are on the horizon.
Well, and naturally we are also getting sort of companies these days that don't necessarily generate profitable revenue, such as things like Uber, which obviously puts a big challenge in there that, you've got stock prices going up, but no real performance backing, at least in the numbers side of that indicates why it should be. It seems to be more hype driven than it does to be.
And the reality is, with a stock like that, if you can't prove through a set of modelling that there will be profitability and that there will be a reason to justify the price, you've got a problem on your hands.
Absolutely.
And let that be somebody else's problem, not yours.
So everyone who's watching this video, do the research. Now, thank you very much for joining us today, Michael. I've thoroughly enjoyed it. We look forward to sort of seeing what your expectations might be in the near future. Perhaps we'll get back together in maybe 6 to 12 months and see if what the challenges are that you're facing then are very different to now, and have a little bit of a chat there and see how it's all sort of progressing along. And of course, I hope you've enjoyed today's video from ACY Securities, and we look forward to you seeing another one in the near future. Have a great trading day ahead.